My name is David Jaffe. Welcome to the Wealth and Health Podcast, where you'll learn valuable skills and positive habits that will improve your life. This podcast originally aired as a video on my YouTube channel at youtube.com/beststockstrategy. The Wealth and Health Podcast is brought to you by beststockstrategy.com. Is fundamental analysis worthless? And if your goal is to make money in the stock market, then I would say that it's about 85% worthless. And I have a different perspective than many of the clowns on YouTube because I worked as an investment banker and would spend hours a day poring over 10Qs and 10Ks in order to find the perfect adjusted EBITDA number. But the reason why it's not going to help you make money is primarily that the market overall is forward thinking. And especially when you have a highly traded liquid company that we like to trade, almost all of the available public information is already priced into the stock. I do believe overall in the efficient market hypothesis, and that's actually one of the primary reasons why I sell option premium. You see, when you sell option premium, you have a statistical edge and you have a statistical probability that you're going to make money. It's basically like turning yourself into a casino. So then that begs the question, why don't everyone who sells options end up making money? And the reason for that is primarily sizing of their trades where they trade too large because options are leveraged products, and secondarily, tail risk. If you don't hedge out that tail risk and eliminate that tail risk, either by proactively buying put options or by trading defined risk trades, then even if you have a statistical probability of making money on every single trade, you can still blow up your account. Here's a really good example. Let's say you walked into a casino with $100 million and you walked to the roulette table and wanted to put $100 million on 24 red. And even though they have a very high statistical probability of making money on your bet, they're still going to reject your bet because if you actually win and hit on 24 red, then you can take down and topple and bust the entire casino on that one trade. So the only way that the casino would accept that trade is by hedging their risk. And that's one of the primary reasons why, even if you have a high statistical probability profit, you can still lose money when selling option premium. But going back to fundamental analysis, the reason why I say that it's 85% bullshit is that net debt, liquidity ratios, capitalization structures, growth versus maintenance capex, all of that stuff is used by investment bankers. We're using that in order to build a financial model to then pitch the company both to private equity firms and strategic partners in order to get the highest purchase price for our client. But in the public market, all of that stuff isn't really important because it's already factored into the current price of the stock. And additionally, all of the financial statements are historical in nature. Even the balance sheet, which takes a snapshot of a moment in time, even though that might be less historical than an income statement or a statement of cash flows, it's still historical and old news when it comes to the market, which tends to look into the future and prices things based upon future expectations. So investment bankers, they're going to read financial statements. They have to read everything because they need to make sure that they take out all of the non-recurring items. They also need to make sure that they arrive at the best adjusted EBITDA because that adjusted EBITDA number can affect millions of dollars in the total transaction value when that deal actually closes. And the reason why we use adjusted EBITDA, because EBIT is basically operating income that's adjusted for the capitalization structure of that specific company. EBIT is earnings before interest and taxes, and then EBITDA is earnings before interest, taxes, depreciation, and amortization. So by looking at the adjusted EBITDA number, you're neutralizing the company's capitalization structure, their debt, etc. You're also backing out the capex and all the depreciation and amortization, and you're adjusting for non-recurring items such as the gain or loss on the disposition of an asset or natural disasters, which could negatively impact your margins for a specific quarter by about 5%. So things like that we're going to back out. But also remember, as investment bankers, we're going to take the last 12 months, we call it LTM adjusted EBITDA, and apply like a 7 to 9x multiple on that adjusted EBITDA number in order to come up with the enterprise value for that company. But the stock market is basically only forward thinking. So it's not investment bankers where we're looking at the past. The stock market is looking towards the future, so there's a huge disconnect. And that's one of the primary reasons why I don't believe that retail traders are going to benefit at all by conducting fundamental analysis. And the larger the company is, the less important it is to do any fundamental analysis. Because the reality is that there's nothing that you're going to read in the 10K or the 10Q or the annual report of Apple or Amazon that is not already known by tens of thousands of people and that's not already factored into the current stock price. The other thing that's really important is that things change. Some of the most valuable companies right now, whether it be Amazon or Microsoft or Google, they burned cash in the 1990s and early 2000s. And if you would look at the financial statements and you did a deep fundamental analysis of those companies' financial statements, then you wouldn't touch them at all because you would think that they were all going to go bankrupt. But that's not what happened. Yes, many of the companies that are cash flow negative, they end up being strategically acquired in tuck-in acquisitions, or they just simply go out of business. But by looking at the fundamentals, especially when it's historical, then the market does not value that nearly as much as it values the future expectations and cash flow that the company is going to produce. And because equity prices are predicated upon future expectations, and I believe in the efficient market hypothesis, and I also don't believe that there's anything that you're going to learn by reading a financial statement, this is one of the primary reasons why I definitely don't believe that retail traders will benefit from reading the financial statements, and I also don't believe that fundamental analysis really has any value to retail traders. Now, if you want to read it because you're interested and you want to do it for engagement purposes, then that's completely fine. But one of the major fallacies is that many retail traders believe that because they put in a lot of time and effort, then they deserve to make money on this stock. They fall in love with the story. They read the annual reports and the 10Ks and the 10Qs, and they feel that because they've dedicated tens of hours or even hundreds of hours into this specific company, then it actually clouds their judgment because many of these 10Qs and annual reports are in essence marketing materials to retail traders. So I believe that it's actually very detrimental to retail traders to read these trading statements and to spend a lot of time analyzing the financial statements because human beings have a sunk cost psychological fallacy. And that means that the more time that they spend investing and researching a company, the less likely they're going to be to sell that company and to act objectively if the stock price does not act in a way that they're expecting. So because of the sunk cost fallacy, I think that it actually causes retail traders to act even more irrational. And then when you combine that with the fact that the market prices equities based upon future expectations and the fact that financial statements are historical in nature, and you factor in that especially for larger companies, there's nothing that you're going to learn by reading these financial statements that's not already priced into the stock. And finally, when you combine the fact that many retail traders are just simply ill-equipped to understand what they're reading, I think that it's a complete waste of time. And in my opinion, I believe that fundamental analysis for retail traders and retail investors is, in my opinion, worthless. So let me know if you agree or disagree. Visit beststockstrategy.com and submit your email address to receive valuable free training. Please give this podcast a positive rating and review. If you have any questions, visit beststockstrategy.com and send me a message.